All right, let's talk about Post Holdings. Now, this is a company you probably think you know, but from an investor's point of view, what you see on the cereal aisle, well, it hides one of the most interesting and frankly aggressive financial stories on the market today. Let's dig in. Right off the bat, we have to get one thing straight. If you're thinking of Post as just grape nuts or honey bunches of oats, you're really only seeing the tip of the iceberg. The company you think you know is just the surface of a much, much more complex machine. And I mean, just look at this timeline to see the scale of this change. Since it became its own public company back in 2012, Post has been on an absolute acquisition spree. We're talking over 22 deals. Yeah, it started in cereal, but it very quickly made these huge, aggressive moves into totally new categories, like food service, refrigerated meals, and then most recently, this massive, game-changing bet on pet food. This isn't just evolution, you guys. This is a radical reinvention of a company. So here's the absolute key to understanding Post. They're not really a food company anymore. They're what you call a consumer packaged goods holding company. The best way to think about it is less like General Mills and more like a financial firm that just happens to use the cash from cereal and side dishes to buy other businesses. Their real skill isn't just making food, it's buying, fixing, and integrating companies. Okay, so this brings us to the central conflict, the big debate for any investor looking at this stock. It's a story with two very different and honestly very compelling sides. So let's start with the bull case, the argument for why this company is a potential money-making machine. So here it is, the whole debate in a nutshell. The bulls, they see a management team that are absolute masters at allocating capital. They've got a proven playbook, they generate tons of predictable cash, and they know how to create value. The bears, on the other hand, see a high-wire act. They see a company that's loaded up with debt, taking on huge risks with these massive deals, all while its original brands aren't really growing much on their own. And this is the Bulls playbook, broken down. It's simple and it's repeatable. They buy stuff, they integrate it to make it more efficient, they use all that cash to pay down debt and buy back stock, and then they do it all over again with the next deal. It's a formula. And for investors, the proof is in the pudding. A 16% compounded annual return on the stock since 2012. That is really, really hard to argue with. And this isn't some old story either. This is happening right now. Just look at the recent results. A 46% jump in adjusted profits over just the last 2 years. This shows that the engine is running. And if anything, it's actually accelerating. And to really put a bow on the bull case, you have this quote from the CEO. He's basically saying that their biggest, riskiest bet ever, that massive move into pet food, is performing at double what they were hoping for internally. For the bulls, this is the ultimate sign that, yeah, management knows exactly what they're doing. Okay, so that's a powerful argument. It's really compelling. But every great story has a counterargument. So let's flip the coin and move to the bear case to see how this all builds a picture of some pretty significant risk. The whole bear case really centers on 4 big fears. Number 1, the debt. Post carries a lot of it, which makes it vulnerable if the economy gets shaky. 2, that huge pet food deal could go wrong. I mean, if they can't turn those brands around, that's a massive problem. 3, the original businesses, the cereals, they're not exactly high-growth engines. And finally, some of their profits are tied to things they can't control, like unpredictable commodity prices. And to put a real number on that biggest risk, the debt, here it is. Post's net debt is 4.3 times its annual adjusted profit. Now, that is a significant debt load. For anyone with a bearish view, this number is like a big flashing red light. It just signals there isn't much of a financial cushion if things go sideways. And here's what that number looks like in context. When you put it next to more traditional, conservative companies like General Mills or Kellanova, you can see Post is carrying way more debt. They are playing a very different and, you could argue, a much riskier financial game. So we have a strong bull case and a pretty scary bear case. So where does the truth lie? Well, the best way to figure that out is to actually crack the company open and look inside its business segments to see what the evidence tells us. This breakdown of where the money actually comes from is incredibly telling. The post-consumer brand segment, which now has pet food rolled into it, is more than half the company. You can see right here how that one massive acquisition has completely reshaped the entire business. And look at food service. It's a huge piece of the pie now, too. So let's frame our search like this. For the bulls, the food service segment is a star performer, a real engine of growth. For the bears, the struggling refrigerated retail segment is a major red flag. The old cereal business? That's the reliable cash cow that funds everything else. And then there's pet food. That's the big bet, the wild card that will ultimately prove one side right. Here you go. Exhibit A for the bulls. Inside that high-growth food service segment, Post is seeing really strong volume growth, up 7.5%, in its most profitable products. Things like pre-cooked eggs for restaurants. This shows there's real organic growth happening in really important parts of the portfolio. And here's the counterpoint. Exhibit A for the bears. That refrigerated retail segment, with brands like Bob Evans, saw its sales fall by 5.6%. This shows that, yeah, not all parts of the empire are firing on all cylinders. There are some real weak spots to worry about. Okay, so after weighing all the evidence from both sides, it all comes down to one question for an investor. What's the price? So let's take a look at the valuation and see how the market is actually pricing this whole complex story. You know, the best way to really understand a company's valuation is to compare it. Is Post cheap? Is it expensive? How does it look next to the other big names in the food industry? Let's check out the numbers. Okay, I know there's a lot of numbers here, but just focus with me on that top line, EV to EBITDA. It's a key metric that's basically the price tag for the whole company, debt and all. You can see Post trades at about 8.8 times, which is a significant discount to both Kellanova and General Mills. The market is clearly saying Post is cheaper. So what does all this mean? The main takeaway is this. The stock looks cheap, but there's a reason. That discount is the market's way of pricing in the risk from that high debt load we've been talking about. But there's another way to look at it. The company generates a ton of actual cash. And it's also worth pointing out that, on average, the pros who cover this stock see over 20% upside from here. And this number right here really drives home that alternative view. A free cash flow yield of 7.6% is really attractive. It basically means for every $100 of stock you buy, the business is kicking off $7.60 in pure cash each year. For investors who focus on cash generation, that's a very, very compelling number. And so we end up right back where we started. It all comes down to this one question. If Post can successfully pull off this turnaround of its new pet food brands, it's going to validate their entire strategy, the high debt, the constant M&A, and it could be a massive win for shareholders. But if they fail, it could expose just how fragile this whole model is. The answer to this question, without a doubt, is going to define this company's next decade.